on markets. Well, Mark Todd from FIIG Securities is joining us now. Mark, welcome to the show. A direct impact or priced in, would you suggest?
Carson, I'm getting some feedback, but I'd say it was priced in, to be honest. I mean, most guys had anticipated. The Standard & Poor's made their intentions well known months in advance, so we were looking for these effects to come through. I think it's more, if you could imagine, it's the way the world is moving. Then North America and Europe go down a notch, Asia goes up a notch, except for the French had already been adjusted. It's consistent with most people, how most people would assess credit at the moment. So it's not unexpected. What is consistent is the fact that the S&Ps of the world are continuing to re-rate and recalculate how they should view these credits. So that's consistent, and they did let everyone know, so there wasn't any surprise in terms of price action. It was just, as steady as she goes, and this is what we think is going to happen.
If you were to distill it down to one sentence, what's at the heart of the new outlook that these institutions now find themselves under? What is S&P really telling us?
Lower growth, more conservative outlooks for everyone. So we are a low growth environment. It's hard to make the easy money, and so everyone should be therefore much more conservative about how they assess credit. Does
this not therefore feed in on itself and become self-fulfilling and actually thwart lending?
Clearly, there's pressure on that credit issue where the capacity to lend is hard. So it's a chicken and egg. If the banks are told that they need to have very high credit standards, it's very hard to then get everyone to meet that credit standard, so they can't lend, and they turn around and say that we've got problems on the balance sheet. It is a problem. It's just something that we're going to... If you can imagine, Treasury came out yesterday and lowered their cost of funds, their expected cost of funds, from 5 to 4%. So everyone needs to become familiar with the fact that we'll be in a low growth environment for the foreseeable future, and so cash rates will stay low, investment rates will stay low, companies won't be able to grow at the rate that they had been growing.
Where do you see Asia fitting into all of this? You make that point about a few upgrades actually being made in that realm. Ironically, do we not therefore run the risk that those same said institutions in Asia repeat the sins of their Western counterparts?
There is a sense that I have is that there's just a better understanding of the Asia banking environment. So should they have already been rated up higher? That's the question I would ask. I mean, some of these Chinese banks are absolutely, stock standard brilliant banks. They're big by capital, they're big by growth. They've got great potential, so they should probably already have been at those ratings. So it's just a matter of people reviewing Asia in the way that we all are. We're saying that will be the driver for the next 10 years. It's certainly not going to be in Europe as a driver of economic growth. America will come back quicker than Europe, sure, but Asia will be the driver for the next 10 years for sure.
The intriguing thing is that sovereign risk has been so much part of this discussion, and when we think China and its banks, indeed all its big names are state-owned, if not a name alone, then by proxy. So how ironic is all of that at a moment like this?
Well, and the other ironic piece is the fact that it's the one state government who's dominating the capitalist environment. So that's the real irony. It would seem fair to say that they've got it on track at the moment, and they've got the controls to manage the economic climate that we're in. It wouldn't be the right economic climate if the markets were moving everywhere and business was very active, but in terms of reacting to the sovereign risks that they see, to some extent the policies that they can implement are the right responses to the troubles you see. We have a problem in Europe where we can't get the one government to control the environment. You flip it over into China and you say, well, that's the answer. If you could have the Chinese model in Europe, we would end this problem a lot quicker.
All right, Mark Todd, listen, we could talk further. We will into the future. For now, I've got to leave it. Thank you.
I'll be unshaven by then.
Listen, well, congrats for sticking with it, staying the course.
Bye.
All for a good cause. We know that all too well. Mark Todd there from FIIG Securities.